Good afternoon, everybody. Welcome to SCORE's webinar, Where's the Money? Go next. For those of you that aren't familiar with SCORE, we're a nationally based not-for-profit organization. We've been in business about 60 years, and our goal is to foster vibrant small businesses through a series of services that we offer. Specifically, our primary vehicle for working with clients is through free and confidential mentoring. We offer a series of webinars and workshops similar to what you're going to be watching today. And we have a very extensive library of resources through our website, which is www.score.org. And in there, we have webinars, templates, courses, lectures, and even some articles and books that are all available for free for anybody that wants to access it. And it's a great resource, and I recommend it. We work with businesses from people who are thinking about starting a business to startups to established businesses. We service and provide our services with a team of about 10,000 volunteers who cover an incredibly broad range of industry expertise and functional capabilities. And we try and share this and bring this to bear to work with our clients to help them achieve their goals. Jerry, go ahead. We are a subgroup within SCORE with the Hudson Valley and Greater New York chapters. I'm not going to dwell on this because everybody will be getting a copy of a recording of this webinar about 24 hours after the webinar is done, and you can get all this information just by taking a look at it, and also everybody's contact information. So let me start off and just tell you a little bit about how the webinar is going to work. Everybody's going to be muted during the presentation. I ask you, if you have any questions, to please submit them, but use the Q&A function of Zoom, not chat. Chat will be disabled. And at the end of the presentation, we'll try and answer as many of the questions as possible. But if by any chance we don't get to them all, because you'll have everybody's contact information, you can certainly zip a quick email or a text or however you want to get to us to get your question before us again, and we'd be glad to answer them as quickly as we can. So again, thank you so much for joining us. Today's webinar, we have a wonderful guest. It's going to deal with financing your small businesses. And the takeaways you can see right here, you'll get an idea of how lenders look at borrowers and what they're looking for. You'll get an idea of what kind of financing options are available to startups. You'll find about ways to deal with a bad credit or a less than perfect credit rating when going for a loan, and a whole bunch of other things. Our presenter today is going to be Jerry Detweiler. She's a wonderful lady, a good friend, and Jerry is NAV's education consultant. She's the author of 5 books, one of which is fabulous, Financing Your Own Business, Get on the Financing Fast Track. Incredibly, the number of questions she's answered are in excess of 10,000 specific questions that she's gotten online. And she's also testified before Congress on credit legislation. So we have a true expert, and I'm delighted to introduce to you Jerry Detweiler. Jerry, thank you so much for joining us, and I'm looking forward to hearing your presentation.
Oh, thank you, George. I'm delighted to be here, and I just can't wait to delve into this topic because it's a confusing one for business owners. If you've just started your business or you've been in business for a few years, you know that as a small business owner, you're probably going to get bombarded with offers for financing. And the types of financing and the terminology is so different from in the consumer world that it could be easy to fall into financing that maybe is not the best for your business. So what I want to do today is really give you an overview of the types of financing that are out there, help you understand, what your business might be eligible for now, what it might prep for the future, and give you some resources. Now, as George mentioned, I've been in this space of credit and financing, both consumer and small business, for a long time now. I am educational consultant to NAV. I used to work there as an employee, and I'm consulting to them. And I will give you a few resources, but SCORE and the SBA don't endorse individual companies, so these are all optional. They'll never impact whether or not you can get help from the SBA or from your SCORE mentors, which I highly, highly, highly recommend. If you've read my articles on the NAV blog, you will see probably every other article I have mentioned to getting help from a SCORE mentor, because as a business owner, it can be pretty lonely. And so having someone to talk to and to help you with your individual questions is just really invaluable. So what I'd like to do before we delve in here is start with a quick poll. And in this poll, what we want to ask is, what's your number one challenge right now to getting financing? I realize you may not fit exactly into these categories, but I'd love to know what you think is like the number one thing that's affecting your business's ability to get financing. And I'm not sure if we have this poll popped up here yet, but when it pops up, you'll be able to. Do you see it, George?
Yes, it is. It's up.
Oh, good, good. Okay. I'm not seeing it on my screen. Oh, there it goes. Okay. So go ahead and choose one of those answers just to give me an idea too, as I focus this presentation too, to help understand what you may be looking for. And as George mentioned, you will get the slides, but you will also get a handout that we have prepared at NAV that goes into these topics in more detail. So while you definitely want to take notes, and especially about the things that are intriguing to you, keep in mind that you will get additional information available. Okay, so let's go over these results. It says that credit is about 9% of the challenge, or 9% of you say that's your challenge. 21% say no or low business revenues. So some of you might be, not making as much money as you hoped by this point. About 39% of you say that you're startups, and so that's a challenge. So we have some resources for you specifically. And then not sure where to look is another 30%. So that gives me a good idea of some of the things I'm really going to emphasize as we go into this presentation today. So let's just first start with an overview of what lenders look for. And every lender is different. Obviously, they all have their own criteria, but it typically falls into three categories. So one is income and revenue of the business. And as you will see when I present some of these financing options, a lot of business lenders will require you to document your revenues with bank statements or other ways. So revenue is really important. Time in business is also important because many lenders have a time in business requirement. So it's often 1 to 2 years. So those of you who mentioned that you're in the startup stage, what I want you to keep in mind is that the steps you take now to make sure your business is, for example, incorporated, or you form an LLC, or you register a fictitious name with the state, those steps can help start that business date, even if you're not making money yet. So when it says time in business, what month and year was your business established doesn't necessarily mean what year your business was profitable. So keep that in mind. Taking the steps to set up your business properly now can pay off down the road. And then the third is credit, which could be business and or personal credit of the owner. So we'll talk on that a little bit too. Now, another thing to keep in mind is that many lenders have what they call restricted industries, industries that they don't lend into. And the way they usually identify this is with something called an SIC code or NAICS code, Standard Industrial Classification System, North American Industrial Classification System codes. These are just codes that were created by the government for statistical tracking purposes, but they've also spilled over into the business credit and the lending world, because they're often on business credit reports, and they lenders may mark it based on the code that is on that credit report, or the code that you include when you register your business. So this is something that's important to get right so that you aren't excluded. I'll give you a quick story about this. We had NAV had a customer who was having trouble getting financing, and his business was manufacturing signs for real estate agents. So the signs that they would put in the front yard to sell a home. And he was having trouble getting financing. And when he checked his business credit through NAV, he discovered that the code that was on his credit report indicated that he was in real estate, but he wasn't really in real estate. He's in sign manufacturing. So when he got that corrected and updated, different kinds of financing became available, because some lenders may or may not want to lend into real estate. So just double check this when you check your business credit. And if you haven't filled out anything where you've been asked for it, if you go to the NAICS website, and it's the official NAICS website through the census, census.gov, they have a tool called Dr. NAICS, and they will actually, for free, either by phone or by email, help you narrow it down, because it can be a little bit confusing. It may not exactly describe your business. You have to find the closest fit. So they have a free tool that will help you find the right code, which can be really helpful. All right, so a few other just foundational steps that I'm going to recommend when it comes to getting financing. First of all, absolutely 100% make sure that you have a business bank account, and that's what you're using for your business, and that you do not use it for personal purposes. We saw so much of this during the pandemic with business owners who were trying to get PPP or economic injury disaster loans, where they just did not have documentation of their business revenues. This is extremely important. And what I like to say is your business bank account should be command central for your business finances. So everything should pour into that. So if you use Venmo for your business, you sell at a farmer's market and you use Venmo, you still should make sure that money gets deposited into that business bank account. And then if you need to make personal purchases, you don't make it directly from that account. You pay yourself, the owner's draw or payroll, however you decide, talk to your accountant, and then you pay your personal expenses out of your personal accounts. If you have an LLC or S Corp, this is especially important because commingling funds can be one of those things that pierce the corporate veil and leave your business open to potential, you personally open to liability for mixing it. So that's just a first step that I highly recommend. Confirm your time in business. So I touched upon this earlier. If you don't have an official start date, like you haven't incorporated or you haven't formed an LLC, then it could be the date you got your EIN, your employee identification number from the IRS. It could be the date you filed your fictitious name with the state. It could be the date you got your business license, whatever one of those early dates is. And what I do, I have a password manager. I have my own corporation. I just put all that information into my password manager so I can always use the correct date. Because if you fill out a credit application, you put a date that isn't accurate, then it might end up in your credit report. It causes problems, and the lender may be suspicious that you're not providing accurate information. So just make sure that you confirm that. And then check your business and personal credit. I know as a business owner, you want to move away from personal credit. That's a great goal, but the reality is a lot of business lenders do check personal credit too. And I will touch on this in the presentation. And especially while your business grows, this will be very, very common. So you want to see where it stands, and we'll give you some resources for that. Now we're going to talk briefly about getting bank loans, because when I talk to business owners and they talk about getting financing, they usually want a bank loan. And if you can qualify for a bank loan, you should do that. This is going to be the best type of financing you're going to get. It's going to be very standardized. It's not going to have a lot of hidden traps or problems that you might run into. So bank loans are ideal. And bank loans can include commercial loans that bank makes, as well as some lenders participate in the SBA program. So that means they've been approved by the SBA to make SBA loans. So they make the loan and the SBA guarantees it. And there's a variety of SBA loans. There's a 7A program, the Express program, which is $500,000 or less. 7A goes up to $5 million. There's microloans that go up to $50,000. There's 504 loans, which are really, really popular for real estate and real estate expansion. There's even export loans. So there's a variety of different SBA loans. And we'll touch on those in just a moment in more detail. But remember, for the moment, they come through banks and other approved lenders. And then lines of credit and term loans. So line of credit is one of the most popular types of financing for small businesses. And I like to think of it as sort of your financial insurance policy. Like, you get approved, it's there, and if you need it, you can tap it. If you don't, great. You might need to use it once a year to keep it active. Some lenders will close it if you never use it, but it's really there for those times when cash flow is tight and you need some access to some money. So you get approved for a certain amount, you borrow what you need. Term loans are great when you have a specific project. You need to put in this equipment so you can, start making more bagels or whatever it is, or you need this equipment for your veterinary practice. Term loans give you a fixed amount of money for a fixed period of time. And then commercial real estate loans can also come through banks and credit unions. And I should say, when I talk about banks, I also mean community banks and credit unions, all of which may make small business loans. And one thing I love about score is that they're often very tuned into what's going on in the local lending area. So they'll often know, they'll have relationships with the local lenders to give you an idea of what may be out there for your small business. So make sure you tap their expertise. Now, business bank loans are harder to get than many of the other types of financing. We'll talk about that. Banks, they have to, by law, they have to manage their risk. You've seen all the discussion about too big to fail and all the other bank requirements. So there are certain requirements, and then they also will just have appetite for certain types of loans. So some may require even a business plan. Not all do, but some may. But often they do want to see, if you're a startup, for example, they want to see that you have experience, or your executives have experience in that industry, that you're not starting something brand new that you know nothing about. These loans can also be great for purchasing a business, and there's advantage there in that there's some financial history to the business that can be beneficial. Most banks and financial institutions do require good to excellent credit. So I've seen some banks with minimum credit score requirements of 680, and we're talking about personal credit here, up to 720 or higher. And if you know how credit scores work, most consumer scores run on a scale of 300. It's the lowest score, at 850 is the highest. And once you're in the 700s, you're considered to have very good credit. 800s, very excellent credit. But most of them do have minimum credit score requirements. So that's one thing you might ask, is just, do you have a minimum credit score requirement? If you've checked your credit, you have an idea whether you're in the ballpark of that. And then banks often love collateral. So they may require collateral. They may even want personal assets as collateral if the business doesn't have that. So that could be whether it's money parked in a savings account or even home equity. Those kinds of collateral requirements are often required, especially for younger and newer businesses. But even an established business, if it has collateral, the bank will probably want to access that collateral. And then we touched on SBA loans. SBA loans are loans that are designed for businesses that can't get similar financing elsewhere, but they still have to be repaid, because if they aren't, then the taxpayers who fund the SBA are on the hook. And so there are guidelines for each of these types of loans, and they often require good credit. The lender has to demonstrate their ability to repay the loan, whether it's from the bank's, or whether it's from the business's income or from projected income of the business, where they're going to have require financial projections. You have to qualify as a small business, and then the SBA doesn't require collateral to be approved. In other words, you can't be turned down if there's no collateral. But if there is collateral and the loan is for more than $25,000, the SBA has collateral requirements to secure that collateral. And that could even be a personal guarantee in your home again. So again, you can't be turned down because you don't have collateral, but if you have it and the loan is for more than $25,000, the SBA is going to take out a lien. So some of you may be familiar with this because you might have gotten economic injury disaster loans or EIDL loans during the pandemic. And for the larger loans, the SBA did require collateral for the very largest loans, but usually it's $25,000 or more. Now, the one tip I'm going to give you about SBA loans, and this is the one thing I want you to understand. Just because one bank turns you down for an SBA loan doesn't mean you necessarily that you can't get one somewhere else. So if you do get turned down for an SBA loan, try to understand whether you don't meet an SBA requirement or whether it's that lender's requirement. So an example would be acceptable credit. The SBA says the borrower has to have acceptable credit. What does that mean? The lenders have leeway to determine. For most loans, there's not a particular credit score that has to be required. It could also be the type of just the industry you're in, that the bank is not interested in lending to that industry, or they have too many loans into that industry right now, and they aren't going to take any more. So really try to, as best as you can, get a sense of whether there's something in SBA guidelines that you just don't meet, or whether it's that lender's particular appetite for that particular loan. Now, I did mention lines of credit, and this is one of the first types of financing that I often recommend for businesses. And with financing in general, the best time to get it is before you need it. You've all heard that expression probably, right? Fix the roof while the sun is shining. and the businesses that have a line of credit in place just have a lot more flexibility because cash flow in most businesses is uneven, and a line of credit, lets you borrow when you need it. Banks, credit unions, and community banks offer lines of credit, but so do a lot of online lenders. So you will have different choices in terms of where to look for that. Some of the good uses for a line of credit might be short-term cash flow issues. Your business is seasonal. You rent kayaks in the summer and there's no kayaking in the winter. So you're going to need, perhaps some financing to get things ready for that summer season. It could be you're waiting for clients to pay you. If you have a business that invoices other businesses, chances are you wait 30, 60, 90, sometimes days or sometimes longer to get paid. So that may be helpful. It can be helpful for working capital, which just means expenses the business needs for its, day-to-day sales, maybe inventory for the holiday season, and then for emergency purposes when, something pops up. It's not great if you find yourself constantly having to turn to the line of credit. You're not able to pay it back as cash flow improves, because that could be a sign the business really needs to improve its cash flow or improve revenues in general. All right, so that's an overview for just bank financing, just to give you a general sense. But now I want to jump into some of the types of alternative and flexible financing that you may see out there, you may get offered, you may wonder about. I want you to understand how they work so you can decide what works for your business. The first one is a cash advance, which is sometimes described as a merchant cash advance or business cash advance. These are very, very popular, and they're also very heavily sold because they can be very profitable for the companies that make these types of, financing offers. And technically, it's not considered a loan, it's considered an advance. So what they do is they look at past sales and they advance against future sales. So for example, let's say you have a nail salon, you accept credit and debit cards. They look at your average credit and debit card sales, let's say for the last 3 months, and then they would give you an advance. In that case, usually 50 to maybe 95% of your average monthly sales. They give you an advance, and then the next time a customer came in and swiped their credit or debit card, a little bit of that sale would go directly to them to pay it back. So it's technically, again, not a loan, it's considered an advance against the future sales of the business. You don't have to accept debit and credit cards. There are some business cash advances that can be based on other types of receivables, but that's the general business model. They're popular because they fund very quickly. They typically don't require any minimum credit score. If they do, it's usually very low. So for business owners who have trouble because they don't have good credit, this is very popular. And then as long as the business is making sales, it's usually not an onerous time in business requirement, but they often do require daily or weekly payments. So if it's daily payments, it'd be business days. So that might be, say, 21 payments days a month. And again, the amount is usually 50% of average, 50 to 100% of average gross monthly revenue. So usually it lasts 3 months average gross. Now, here's where it gets confusing for business owners. They don't typically explain the cost as a factor rate. As a APR, annual percentage rate, which is what we're used to in the consumer world, right? You go to get a mortgage, you go to get a car loan, you see an APR. In the business world, they typically describe this as a factor rate. So an example would be a factor rate of 1.2. So if you're thinking in your head in terms of APR, you're thinking, oh, 1.2, that sounds really good. What a low rate. But it's 1.2% of the amount you advance that you'll pay back. And the actual APR, the actual interest rate, depends on how fast you pay it back, because that's what APRs are about. They translate, the cost of financing over time. So we have an example in this little just APR calculator. It's on the NAB's website if you want to check it out. You don't have to register or give an email address to use it. But in this example, simple example I gave, someone gets $100 advance, they have to pay back 120 because it's a 1.2 factor rate. So we take that 100, multiply it by 1.2, and then they're going to pay it back as 10% of future sales. Their APR works out to 38%. The equivalent APR for that type of financing, 38% would probably be low. I've seen it as high as 95% or more. actually, there was one Forbes article where a hair salon owner was offered this type of financing, and the interest rate was over 1,000% APR. That's not typical, but usually it's anywhere in the, I don't know, 30 to 80% range when it gets worked out to an APR. So that's why I want you to be on the alert. So when you see the cost of financing listed now, New York is one of the few states, there's only 4, I think, right now in the country that passed new disclosure laws for businesses to get clear disclosure of the cost of financing. I'm not sure what the status is in New York yet because it was held up for regulatory approval, but that will hopefully give you better information about the cost so you can compare different types of financing between each other. Another type of financing that's popular with businesses who invoice other businesses. So maybe you have a law firm, and maybe you have an architectural firm, any kind of business where your clients are other businesses, you probably invoice them. So in this case, invoice factoring can help businesses get paid faster. And what happens here is the financing company will take the invoice that is due, say in 30, 60, or 90 days. They'll advance a majority of financing to the business. They'll collect on the behalf of the business, and then they'll take out their percentage and give the rest to the business when the invoice is collected. It's very, very common in certain industries, real estate, fashion. There's a few industries where factoring is just super common. I'll give you a quick example. I was at a conference where I sat, this was in Atlanta, the home of Coca-Cola, and I sat next to a gentleman whose business is factoring invoices for companies that do business with Coca-Cola. Companies that do business with Coca-Cola need to get paid, and Coca-Cola is a big company. Like if you ever get to do business with Walmart or one of the big retailers, they're going to take a while to pay you. They have that leverage. And so what he would do is invoice or factor those invoices, knowing that Coca-Cola is going to pay its bills. It was just going to take time to pay it. So he was making money by providing those funds more quickly to the business. With invoice factoring, they typically are not that concerned with your business credit or even your personal credit. They're concerned about the reliability of the business that owes you money. Because in our case, this guy was collecting from Coca-Cola, so he knew they were going to pay, right? So they are concerned about the client's credit. How reliable is the client? They typically only invoice B2B invoices. So this is not going to be if you're selling something directly to consumers on a payment schedule, for example, and it's not a substitute for debt collection. So this isn't an answer if you have a client who hasn't been paying you. You still need someone to help you with debt collection, not invoice factoring, because that would be too high risk for the factoring company. Another type of loan I want to mention, especially for those of you who have newer businesses or maybe smaller financing needs, or really are having trouble getting financing, is microloans. So microloans are typically made by nonprofit organizations. Community Development Financial Institutions, or CDFIs, is one example. The SBA also has a microloan program that goes up to $50,000. And Kiva, KIVA.org, which is a combination of microlending and crowdfunding, offers loans at 0% with no fees to businesses up to $15,000 in the US. They're a nonprofit organization, and it's truly a sort of philanthropic lending type of situation. Axion is another lender that's all over the country that offers microloans. But again, your score mentor may be familiar with resources in your state and your local area that may offer microlending, your community. So the trick with the challenge with microloans for you as a business is that you have to go out and find them. These are nonprofit organizations. They don't have big budgets to go out and advertise and send a lot of direct mail. So you have to be a bit proactive. So start with your score mentor to see what resources they know about. You can also check with OFN, which is the Opportunity Finance Network, OFN.org, and they have a list of microlenders around the country. So that may be helpful. It's often geographically specific. So it's often going to be targeting a certain geographic area, your community, because the goal is to bring economic development to your community and support job creation. The small loans amounts may be small, as little as a couple $100 to $50,000. but they may be startup friendly and they may be more credit flexible. And then they also often come with technical assistance, which is similar to what you get from your Score Mentor, assistance to help your business be successful. So they're great loans if you can qualify. Another type of loan that we don't often think of as a loan, but it can be, is a business credit card. And business credit cards are particularly interesting to startups because most business credit card issuers don't care whether your business is making money. They don't care how long you've been in business. They don't care if it's incorporated. What they're going to look at is your personal credit score and income from all sources. So with these small business credit cards, you're typically going to need at least a good credit score. So we're probably talking a minimum of 650 for most credit cards. And then you're going to have income from all sources, which could include, a spouse or partner who is working, who would be willing to pitch in. You list your household income on the application, and that could include, someone else in the family who's willing to pitch in if necessary. The other thing to keep in mind with business credit cards is they may not affect your personal credit, which can be very helpful if your business does need to run a balance at certain times. So let's say you do buy a lot of inventory for Halloween season. You sell Halloween costumes, you buy a lot of inventory, and then you sell it, by October 31st, hopefully. You may run a high balance. Well, if that's on your personal credit, that high balance could really ding your personal credit score. But if it's just on your business credit, it's not as significant a factor with business credit as with personal credit. So you may be fine doing that periodically. There's 2 links here on this slide. And the first one, nav.com/reports, tells you which business credit cards do or don't report to the owner's personal credit. So if you want to keep your business and personal credit separate, that will be helpful. And then the second one talks about which ones report to business credit. And almost all the major issuers that you're familiar with, Amex, Chase, Capital One, Bank of America, et cetera, will report to at least one of the business credit reporting agencies. So on-time payments can help you build your business's business credit. Now, another thing to keep in mind is that there was a law passed in 2009 called the Credit Card Act that gave a lot of protections to credit card holders, but it does not affect business credit cards. So with your business credit card, one thing to keep in mind is that if you miss a payment, if you are 5 hours late with your payment, the issuer may raise your interest rate, and it's probably going to be a much higher interest rate, and they can extend that to any outstanding balances as well as any new purchases. So if you use a business credit card, it's especially important that you don't miss your minimum payment. You want to make sure you make that minimum payment on time. So what I do personally and what I highly recommend is you set up automatic payments for the minimum payment. So you can go in and pay the whole thing off if you want, but at least that minimum payment is paid on time so that you don't end up in a situation where you miss a payment, interest rate goes up, and then you're stuck. The other tip I'll give you real quick here is that there are about a dozen card issuers that offer 0% intro APRs on business credit cards, some as long as a year or more. So for those of you in the startup phase, if you have a solid business plan, you feel very confident about it, you're working with your Score Mentor, you're not just gambling here, this could be a low-cost source of startup financing while you start to bring revenues into your business. Of course, you want to be careful because there is going to be a personal guarantee. If you don't pay back that debt, they can come after you personally. But if you've made a calculated decision to take on that financing, a 0% APR business credit card could be a good idea for your business to consider. I don't know if you've seen this book, Pancakes in Paris. It's one of my favorites. And I actually got to visit the restaurant, Breakfast in America, in Paris when I was there a couple years ago. The author, Craig Carlson, was in the film business, and he decided to open the first all-day breakfast diner in Paris. And he shares his adventures in this book, which is a really fun read. And in the book, he talks about all the setbacks that he experienced trying to open this up and all the red tape he went through. And there was a point where he almost didn't open his restaurant, but he says that the way he was able to open was that he was able to get all the ingredients he needed to serve breakfast on credit. So, you know, his bacon and the coffee and the wine, because you must have wine at their all-day breakfast dinner in Paris, the eggs and everything else, they let him get it and pay for it out of sales from the business. So this is called vendor or supplier credit. You might hear it referred to as net 30 or trade line credit. This is credit where your suppliers let you get what you need and pay for it later. And it's one of the most common, but sometimes overlooked forms of credit in small business, because unless you know about it, you might not be looking for it. But as you look at the things your business buys on a regular basis, one question you can ask is to that vendor or suppliers, hey, do you offer credit? And many of them will. And so this could be one of your best sources of short-term financing. Now, usually they offer credit for 30 days, net 30 terms, means it's due in 30 days. As you build credit with them, you might get net 45 or as long as, you know, net 180-day terms, depending on the supplier. They usually don't charge interest, but you might give up a discount. So in some cases, they might offer a discount, like say 2% if you pay in 10 days. You might give up that discount if you take 30 days to pay. They usually don't check personal credit. And if they report to business credit, that helps you build business credit. So if part of your goal is to build business credit, we do have a list of easy to get net 30 vendors that don't check personal credit at nab.com/vendors. That's an article that I've written and update periodically. So that might be helpful for you as you explore this type of financing for your small business. And then let's touch on just a couple more types real quick so we can get to questions. Crowdfunding. Crowdfunding is on a tear, and a lot of, and I mean in a good way, a lot of businesses are using crowdfunding to raise money for their business. So the most popular type is the type you're probably familiar with, like Kickstarter, Indiegogo, those platforms. That's rewards-based crowdfunding. Someone creates something, they offer usually a beta version of the project or the product, if for people who are backers, but it could be all kinds of different rewards depending on what your business does. And so an example is I recently, I like to travel. And so I've been seeing ads on my social media feeds for this brand new head mask that comes down and holds your head against the seat. And they were asking for, I think it was $50,000 on Kickstarter, and they've raised over $1 million on Kickstarter from people who want that product. So it's an early version of the product. So rewards-based crowdfunding is very popular for a product-based business, although like Kickstarter is often used for creative projects too. Musicians, artists, and other types of creatives often use it to raise money. Debt-based crowdfunding is where you borrow money and you pay it back. So we mentioned Kiva earlier, kiva.org. As I mentioned, they're a nonprofit, 0% interest, 0 fees. And what happens with Kiva is you go on the platform and you raise money from backers. So it is a form of crowdfunding, but then you pay it back. So they do expect it to be repaid. And then that money that's repaid goes back to fund other businesses. There's also a few options for debt crowdfunding that charge interest or may have other forms of repayment for that debt. And some of the investment or equity platforms include the option of debt as a possible way to raise money. Equity-based crowdfunding or investment-based crowdfunding is also very, very popular. It now goes up to $5 million once a year. And this is where you can get investors in your business. There's a variety of ways this can be structured, but this is also a very popular way to bring in others. And some of the people I've talked to who have done crowdfunding point to other benefits besides the money. Loyalty. So if you have customers who, let's say I interviewed a restaurant owner who offered different rewards for the backers of her campaign. It was a debt-based campaign. They paid it back, but they could come in and get a free glass of wine once a month. They could come in and get a free appetizer every so often. There's a loyal fans. And if they are investing as investors in the business, they want to see the business succeed, right? So they're also going to be hopefully talking about the business and recommending the business to other people. So there could be a lot of benefits to this type of funding. And then donor-based, like GoFundMe. That was really popular for businesses during the pandemic, not as popular now. I think more now, people who invest in crowdfunding campaigns are looking for, a reason to back this business. So they're often startup friendly. There's lots of different platforms which may cater to specific types of businesses. And you get this cheat sheet that I mentioned at crowdfundbetter.com. She has put together a terrific list of all the platforms and the focus of those platforms. So I'd recommend, if you even thinking about this, to go ahead and get that. They very rarely check credit. It's very, very rare for credit to be checked. And they're generally pretty cost effective. But this is not something where you just throw up a video, and unless maybe the face mask that took off, I don't know, but they were advertising a lot too. So they were spending money advertising. But it's not something where you just put it out there and suddenly, you're going to have to work to get people to see your campaign. And most successful crowdfunding campaigns start with backers, people who the business owner knows. So that could be friends and family, it could be business colleagues, it could be loyal fans of your business, etc. So many campaigns don't fund because people don't understand the work that has to go in to make that campaign successful. And there's some great resources at crowdfundbetter.com. They also could be taxable, depending on the type of crowdfunding, and it can take time. So just like if you're a business owner trying to raise money, you know that it takes time to do that. Well, that can happen with crowdfunding. We'll touch real briefly on using retirement funds for business. There's several ways you can do this. One to be just withdraw money out of your retirement account, but you could face taxes and or penalties depending on when you do it and the type of retirement funding that you have. So always talk to your tax advisor. If you have a 401k or 403b, or if your spouse does, you may be able to borrow against it. You cannot borrow against an IRA. And the danger there is, in some cases, if you separate from the employer, it has to be repaid immediately. So that's something to take a look at. And then another popular form of retirement funding, the ROBS plan, that's where you roll retirement funds into a C corporation. The C corporation funds the business. You have to be very, very careful with these. They are popular, but you really have to know what you're doing to make sure that you don't run afoul of IRS rules and then trigger a tax event. And there's been some actual studies by the IRS where they found that most participants weren't successful with this type of funding. So just be very, very careful if you're considering it. Understand that, talk to your tax advisor, in other words, because that could be very, very important. All right. And then equipment loans and leases. These may be available to newer firms. They're usually pretty credit score flexible, especially if you get it from the manufacturer of the equipment who wants you to buy the equipment. There may be some great tax advantages, but they may also require a down payment. So we've put a little short cheat sheet here of the different types of leases that are out there. What I would say is talk to your tax professional, because there's some really good depreciation benefits still available to certain types of leases, but you want to navigate that with the help of your tax professional so that you do the right, take the right approach for your business. And this will be on the handout, so you could explore it in a little more detail. All right, we're almost done, and then we're ready for questions. So small business grants. When I did a small business grant webinar for SCORE at the national level, it was their #1 most attended webinar everywhere, anytime, because people want grants, right? This is free money that you don't have to repay. That webinar is on the score.org website. So if you go to score.org, I think it's /nav, you'll see that webinar. If not, just search for small business grant webinar. Goes into more details, but I put up a few resources here for you and a link to an article I've written about grants. The #1 thing I want to tell you about getting a small business grant is that it's going to take work. It's not guaranteed. And you have to really understand the motivation of the company or the foundation or the organization making the grant to make sure that you fulfill what they're looking for. So it's not charity, it's an opportunity to partner with an organization that's offering a grant to help them reach their goals. All right, so we've covered a lot. We're going to put up a poll here, and I just want to hear from you what type of financing you might have learned about that you might want to explore in a little more detail. And I just want to give an overall comment why we're taking this poll, and that is that for most businesses, you probably are not going to get a single loan that's going to do everything for your business. You're probably going to piece together different financing at different times and maybe combine different types of financing to reach your goals. So for example, if you're a startup, you might get a 0% credit card. Maybe you get 2 0% credit cards. And maybe you can also do a Kiva crowdfunding campaign and get $15,000 as seed money to get to the next step. And then maybe as your business grows, you might end up getting an SBA loan, or you might qualify for a bank loan. So very typically, business owners will stack different types of financing. What's really important is just to always be on top of the cost of that financing and understand, what it takes for you to pay it back and get to the next level. Because we do see business owners who end up with so much financing that they can't really manage it very well, and they're overwhelmed and they end up in debt that is difficult to repay. All right, so let's go through these results and then we can take some questions. 36% of you mentioned an SBA loan. That's great. That's great financing for your business. 33% of you mentioned microloans. Good. And 21% mentioned crowdfunding. So all those resources that we mentioned that will be in the slides and the e-guide will hopefully be helpful as you pursue that, and then talk to your SCORE mentor for more help. Invoice factoring and vendor terms were also of interest for a few of you. That is kind of limited. It depends on the type of business that you're engaged in, whether that would be something that's available to you. But hopefully that gives you an idea of what people are looking at. And I think it's time for us to go to some questions.
Good, Jerry, that was fabulous. Thank you very much. Really, really informative. Whole bunch of
You're welcome.
information for me, and I hope for everybody else found it very valuable too. Let's try some of the questions. The first question from Howard is, has it become more difficult to raise funds in the past 12 months, I assume, than the preceding couple of years?
Yes, so if you're talking about angel funding or venture capital, yes, all the research points to it becoming more difficult. So here's the bright news, the bright side of that. The bright side of that is crowdfunding is rolling. I mean, it's just on a roll. So if you're having trouble raising money, venture capital or angel funding, which is very difficult, and the statistics show, especially for women-owned businesses, minority-owned businesses, or businesses in rural areas or outside certain, tech hubs or whatever, it's difficult to raise money that way. So look into investment crowdfunding. It might be something worth exploring. And while I wait for the next question, I'm going to give you a couple of resources. I realize I skipped that slide. You are going to get this e-guide as a handout, so I hope you will find that helpful for summarizing what we talked about. NAB does help match business owners to financing. Again, you're under no obligation to check this out. It also will give you access to your detailed credit reports and for business credit scores and monitoring. So you can check that out at nab.com/score. And then we are officially at the question section. So ready for another one.
Just a note, Kim, you sent a question which was, do you have the link? Would you please elaborate on it and resubmit the question? I think I don't understand the question, so my fault, but if you could help me out, I appreciate it. We have another question on no documentation loans. Is that real? You don't really need documents to get a loan?
NAB works with a variety of different types of lenders, and there's no lenders that require nothing. So, I mean, I guess you could say something like maybe Kiva, because they don't require financials, but most business financing companies at a minimum require 3 months of business bank statements. So that's a very, very common requirement for most types of funding. If it's invoice factoring, they're going to require the invoice and accounts receivable aging report. So they're going to want to look at what invoices are outstanding. So it really depends on the type of financing. Maybe a business credit card, you just apply online. You don't really have to back up the information, but you should be. Here's what I would be prepared for if I were thinking about financing. I'd have a business bank account. I'd have the 3 most recent statements available. I would have checked my business and personal credit. I'd have my business license, articles of incorporation, or articles of organization for if you have a LLC or corporation, that information ready. A copy of your business lease if you lease your location, and then your personal ID. Banks in particular require by law for anti-money laundering purposes to require the business owner's personal information and verify that. So with that documentation in hand, that should be what you would need to initially start the transaction process.
Oh. Angela asked a question that's pretty interesting. What about businesses that earn income primarily from commissions?
Commissions are fine. The lender's gonna typically look at the business bank statements, and they're gonna look at the amount and also the number of clients. So if, let's say you're a business that has 2 clients, that's very risky for a lender, because one client leaves, you've lost 50 or more % of your business. So banks will like to see income coming in from various sources, not just one particular client. The exception would be the government. If you have government contracts, that may be perfectly adequate for certain types of financing because it's considered a reliable creditor. But generally, most that look at bank statements are going to want to see at least 5 different sources of income coming into the business, and they're going to average it. So it would just depend on when it hits your business bank account, how much is coming in terms of what you qualify for.
Thank you. Kim responded, the link that she requested was, do you have a link for your presentation on grants?
Oh, yes. Okay. So that's on the SCORE website, score.org. And while we're talking, I will go ahead and look it up real quick here, George, and then I will try to make sure I share the correct link. But I think it's score.org/nav. I just should have put it in the presentation, but we can always make sure we include it in the follow materials too.
Excuse me.
Okay, no problem.
While you're looking and getting that, I will move ahead with the next question and just get you multi-processing as you're link. The interesting question is, can I use the inventory that I plan to purchase with the SBA loan as collateral for that loan? It's like a 504, I guess.
Yeah, I'm trying to remember what the inventory require. I don't remember off the top of my head, so I don't want to tell you wrong what they will. But remember, if you don't have collateral, the SBA cannot turn a lender who makes an SBA loan can't turn you down for lack of collateral. So if they want that collateral, you may have to pledge it, but just because you don't have it doesn't necessarily mean you can't get an SBA loan, if that makes sense. In other words, the SBA, they like to get collateral, but it cannot be a condition of getting the loan.
Let's see. What are some of the considerations about getting financing to buy a business? Let's say a couple $1 million business.
Yeah, so I would definitely talk to an expert in SBA loans for acquiring a business, because those can be excellent loans for business acquisition. I would also find out if there's someone in your SCORE team who has experience with business acquisitions to help you as you put together that financing. And then there are individual lenders who offer, business acquisition financing loans, which would be term loans, similar to what we talked about earlier, where you're borrowing a certain amount of money in order to finance the business. One thing that's been happening more recently is that because there are so many businesses for sale, a lot of baby boomers are just done and their kids don't want their business. There's a lot of creative financing can happen. So it's not unusual to see business acquisition deals where, maybe they borrow 50% and the owner finances 50% and finances that over a couple of years or a few years. That can have tax advantages for the seller and can also be more manageable for the business owner. So I would absolutely talk to an SBA lender about a business acquisition loan if you have, acceptable credit, because that could be a very good way to finance it. And I did, by the way, look up the presentation. It's on score.org/nav, NAV, and you'll see a list there. And if you scroll down, you'll see one that says how to get a small business grant recorded webinar. So there's both a blog post as well as a webinar on there, and the webinar is archived there. You can watch it at your convenience.
Perfect. And I think that answers a follow-up question from Angela about the same thing. So that was good. Another gentleman has attempted to obtain a microloan from several sources, apparently without any luck. And the challenge seems to be that it's for a liquor store.
Yep. So a liquor store in general is one of those industries that can be harder to finance. So there's certain types of industries which include anything alcohol related, gambling, different types of guns and ammunition stores. Those can all run into financing hurdles. So I don't have an easy answer for you. You're going to have to look for a lender who accepts that type of financing, or you may have to look for some seller financing or friends and family, or perhaps some of the other more creative options we talked about, like business credit cards.
Okay, thank you. Sharon asked a question. Interested in knowing if there are still loans that align with government contracting. This particular person is anticipating a proposal award and will need funding for it, and that's basically the genesis of the loans for contracting.
Yes, yes. There are companies that actually specialize in that version of invoice factoring that we talked about for government contracting. Because a lot of times with government contracting, you may have to get an expensive surety bond, you may have to staff up, you may have to buy more equipment, et cetera. There can be a lot of upfront costs. So landing a government contract is great, but you have to be able to fulfill it. And there are companies that do essentially what's invoice factoring for government contracting. So if you just search for government contract financing and look for companies that specialize in it, you'll see several that's what they do. And then of course you can also look at the SBA financing as well.
Perfect. And the last question I have right at the moment is Jason asked, can I structure a grant so that I can pay myself during the startup process?
It depends. If you get a grant that allows you to do that, that's perfectly fine. Usually grants are, it depends on, the terms of the grant. So government grants have a lot more detailed requirements than say a foundation that's giving a grant to a new small business. So it really depends on where you get the grant. Now, I have to caution that grants are hard to get. It's a lot of work. So sometimes it's better for the business to focus on just getting the business off the ground and applying for grants as they come up. But it depends on the type of business, whether you want to, put a lot of effort into that. But the resources that we mentioned on that slide and the webinar that we mentioned will talk more about getting business grants so you can get a better sense of what they are. They're just competitive and they can be hard to get, but it just depends on the terms of the grant. Some are private companies and they don't care how you spend the money.
Well, that's wonderful. I think that kind of takes care of the questions that we have on hand right now. I tend to think that you will probably get more than a few emails with questions as people start to, cycle through some of the comments and the suggestions you've made and apply them to their particular situations. But we were kind of focusing on more generic questions. And, hopefully we've answered everybody's questions satisfactorily. I had a fantastic time listening to you, Jerry, and I thank you so much for sharing that much wisdom with us. I think it'll be really helpful to all the people who are on board here and those that will be getting your presentation in the mail tomorrow. So again, Jerry, thank you so very much. Ladies and gentlemen out there, thank you very much for joining us. We appreciate your support and attendance, and enjoy the day and good luck in getting your loans. Jerry, thank you much.
Thank you.
Let me just add one last piece. If you would forward one more. Our next presentation that's coming up is on September 20th. The same group of SCORE chapters will be highlighting some of the successful clients that we've worked with over the last year or so, telling their stories and some of the challenges they overcame and some of the solutions they discovered. So I invite you all to attend it on then. Hopefully see you then. But in the meantime, thank you again for joining us and have a wonderful day. Goodbye all.